Hello everyone. Today I show you my stocks portfolio performance. I will tell you why I sold MasterCard and Tencent holdings and buy more shares of Google, Novo Nordisk and Louis Vuitton. I will also discuss my opinion about HIMS and HERS and why I avoid to buy into such businesses. We will discuss the passing of EQ Bank CEO Andrew Moore and why despite this news, EQ Bank stock is almost up 10% in the last few days. I will briefly discuss Alimentation Couche-Tard earnings report, and finally I show you the exciting software that I'm working on and how you can sign up for early access and pre-launch discounts. Let me start with the portfolio overview. In this channel, I don't tell you what stocks to buy or sell because I don't know about your investment goals. I don't know about your risk tolerance and your financial situation. But I will tell you what I am doing with my own money, and I show you the process of evaluating different companies and my process of long-term investing. I will try to update you every month with a full transparency and show you the exact performance of our portfolios over long term. The combined portfolio of our family, me and my wife, is worth a little bit over 172,000 Canadian dollar today, and we are up 73% from where we started investing in these portfolios, which was almost 3 years ago. We had this amazing performance by not taking on so much risk, which makes this number even more impressive. We do not invest in speculative assets and companies, and we obtained this performance by investing in undervalued solid businesses around the world, companies like Meta, Google, Brookfield Corporation, and less known solid businesses like EQ Bank. I personally have almost 117,000 in Wealthsimple, which is up 58%, and $13,500 in National Bank direct brokerage account. We have also close to $45,000 in this smaller separate Wealthsimple portfolio, which has an impressive 314% return in just 3 years. As our wealth is combined, we manage all of our assets as a single combined portfolio, which I track them here. As you can see in this new website project that I am working on for a couple of months now. I used to use this Excel sheet to track the positions, but now I moved on to this new software to track my positions. Pretty much everything is automated in this new software, and I added new features and insights, which makes tracking of positions so much easier. Let's look at the overall portfolio allocation. This is a nice graphical representation of the stocks we hold in our combined portfolio. This is an overall concentrated portfolio with only 10 different companies. The largest holding here are Meta with 17% weighting, Brookfield Corporation with 16% weighting, followed by Google with 15%, EQ Bank with 14%. Then we have Alimentation Couche-Tard with almost 10% weighting, Louis Vuitton and Amazon with almost 8%, Novo Nordisk with 6%, Aritzia with 4%, and finally a tiny position in Intact Financial with only 1% weighting. The portfolio is pretty concentrated, as you can see, which shows how much I believe in these companies. If the share price is right, the plan is to build a larger stake in Intact Financial so we can have a much more balanced portfolio at the end. Okay. Next, the software will show me the geographical allocation. As you can see, 45% of our assets are in Canadian companies, 40% is in US companies, and 14% are in European companies. No exposure to China or other markets at the moment. We almost have equal weighting in terms of US dollar and Canadian dollar in these investments. So almost half of our investments are in Canadian dollar and half in US dollar, which is a good balance that I like. In terms of the sector allocation, tech stocks are 40% of the portfolio, which may be a little bit too much, but most of that came from capital gains. Then we have financials, consumer staples, consumer discretionary, and healthcare stocks. So a relatively nice diversification in terms of other sectors. Finally, we can look at the best and worst performers in my portfolio here. According to the software, Meta is my top performing stock, which is up 384%. This is ridiculous. Followed by Aritzia with 82%, Amazon with 77% gains, EQ Bank with 62% gain, and finally we have Brookfield Corporation with 62% gain, which is all great performances. These are all amazing performances by my top 5 stocks. In terms of the worst performers, we have LVMUY or Louis Vuitton, which is definitely the worst performing stock of mine with a minus 19% performance, followed by Alimentation Couche-Tard with a minus 6% performance. This software is called Yara IQ and not only has this portfolio tracker, it also have a DCF calculator which I use to analyze the stocks. It has legendary investor tracker with nice graphical charts for each legendary investors. It also has a stock fundamental analysis tool with AI assisted insights, which all will be available for early access in the next couple of weeks. If you're interested, you can go to yaraiq.com and sign up to receive an email from me when the software is ready for early access and secure a 20% discount for the first year. I will put the link in the description of the video. You just need your name and your email address at this stage, sign up, and I'm 100% sure that you will like the software. Okay, in terms of the individual account performances, let's look at my personal RRSP account first. My Wealthsimple RRSP account consists of only stocks that are traded on US stock exchanges, and it is up almost 68% so far in the last 3 years. The first thing that you notice here when you look at the portfolio is that MasterCard is not here anymore. I was up almost 40% on my MasterCard position, and last week I decided to sell out of MasterCard entirely and consolidate my positions by buying more shares of Google and Novo Nordisk instead. MasterCard is definitely a solid business, one of the best businesses in the world. But being one of the best businesses in the world that everybody knows about is not always great because it makes your stock more and more expensive over time as everybody wants to own this great business. That's exactly what happened with MasterCard. Price multiple was just a little bit too much for me, and while I still believe MasterCard is an amazing business, I decided to sell the position where I believe the stock was slightly overvalued and put that money into 2 other stocks that I believe are also have great quality but are severely undervalued here. Google and Novo Nordisk. I should talk about Google valuation in another video, but in summary, I believe Google fair value today is around $210 and the stock was trading for $165 when I bought it last week. Same with Novo Nordisk. I believe Novo Nordisk fair value today is around $85 and the stock was trading close to $68 when I bought more shares last week. With that consolidation in place, here I have 36 shares of Amazon, which is up 69% so far. So Amazon by far was my best performing stock in this portfolio, and I started to add this stock in January 2023, which was probably one of the best times to buy Amazon. I wish I bought more shares during that time, but it is what it is. I think Amazon here is fairly valued. It's not super attractive to me, but if the share price goes lower than basically goes to $170 range, I will buy more shares again. I bought 15 more shares of Google and now I have 100 shares of Google here, which is up 46% so far. I think Google is offered one of the best risk-reward profiles in the market now, and I have no issues adding to Google here. Finally, as I mentioned, I also bought 45 shares of Novo Nordisk, and now I own 120 shares of the company, which is down around 1%. I like to add to Novo Nordisk here at this price range as I think it is undervalued. With Novo Nordisk, there were a couple of news this past week. Wegovy will be replacing Zipbound at CVS Pharmacy, which is great, and it will also be offered at Weight Watchers. Novo Nordisk has also stopped their agreements with HIMS and HIRS due to them continue compounding GLP-1 products. Novo Nordisk accuses HIMS and HIRS of failing to adhere to laws that prohibit mass sales of compounding drugs under the false guise of personalization. So they mentioned that compounding is generally intended for individual patients that their needs cannot be met by an FDA-approved drug, like if somebody has allergies to a specific ingredient or something like that. But it's not similar to what HIMS and HIRS are doing right now with selling these drugs to the masses. So some people ask me during the week about my opinion about HIMS and HIRS. I never deep dived into their business and balance sheet. And the reason is simply I do not invest in businesses like HIMS and HIRS, no matter how good is their balance sheet or growth matrix. My reasoning is that the downside risk of investing in such businesses is so huge that will surpass any upside potential. Unlike commercially manufactured drugs by legit companies like Novo Nordisk or Eli Lilly, compounded drugs are not reviewed or approved by the FDA. They do not undergo the rigorous clinical trials that FDA-approved drugs must pass, and they usually try to utilize extremely risky practices for profits. And that is in a sensitive domain like healthcare and drug discovery, which will raise serious concerns from both consumers and regulatory bodies. HIMS and HERS and similar businesses always have something that I can explain it as lack of risk disclosure. It basically means they minimize or discard crucial information about the potential side effects, risks, and contradictions of their drugs. All in all, it means a single lawsuit is enough to send these companies into death spiral. And I would never invest in a business where the whole business model is based on maybe borderline illegal and unclear practices. I think that's enough for HIMS and HERS. As I mentioned, I will never invest in such business, but maybe HIMS and HERS are actually doing legal stuff. I don't know. Maybe the stock can double in 2 months, so nobody knows. But I try to not make huge mistakes with my own money, and I try to invest in businesses that are safe, that I know their business model very well. And investing in a business like HIMS and HERS is the opposite of this strategy, and that's why I avoid it. I would say if you want to invest in a business like this, at least do not go all in and invest just a small portion of your money. Okay, now let's move on to my next position. Outside of the Wealthsimple, in National Bank Direct Brokerage RRSP, I did another consolidation by selling out of my Tencent Holdings shares. I sold all of my shares entirely for 80% profit and putting all that money into Louis Vuitton. When I bought Tencent, everybody was telling me that this was a mistake. I think Tencent had a price to earnings ratio of like 14 when I bought the company. It quickly went up to a price to earnings of almost 25, and I had almost 80% profit in the company in less than 2 years. I was in a weird situation with Tencent. I like the business. It is definitely a solid business, but I had a small stake in the company relative to my portfolio size, and I couldn't pull the trigger to buy more shares here as I saw better opportunities with other stocks like Louis Vuitton. So I decided to sold my position for a nice profit and consolidate it with LVMUY. Now I own 93 shares of LVMUY, which in my opinion is extremely undervalued here. I should do a separate video on valuation of Louis Vuitton, but I believe the fair value of this company is around $160 today, which means the stock is undervalued in my opinion. And that's why I bought more shares of the company here. Okay. Now let's look at my personal TFSA account first, which performed very well this year. This portfolio is only consists of Canadian stocks. Its value is close to $70,000 and it is up 52%. It is a little bit underperforming my other portfolios, but considering it only consists of Canadian businesses, it is still widely outperformed Canadian market indices in the last 3 years. Here I didn't have any significant changes. I only bought one more share of Intact Financial. Okay, let's start with Alimentation Couche-Tard. I own 250 shares of this company, which is down around 6% at the moment. They recently had their earnings report. Adjusted net earnings was down 4.3% year over year. Total merchandise and service revenues was up 2% year over year, with a decrease of 0.4% in the United States and an increase of 3.4% in Europe and 3.5% in Canada. Same-store road transportation fuel volumes decreased by 1.9% in United States, by 0.6% in Europe and other regions, while it increased by 3.7% in Canada, and their margins was also decreased slightly. You can see here that most of the revenue of the company comes from their fuel business, but the high margin part of the business is not fuel. It is actually the merchandise sales, particularly in United States, that has major impact on the overall profitability of the business. Even when they saw growth in Canada and Europe, As the United States business is just much more meaningful part of their overall business, they still see a decline. The stock was pretty much flat after this earnings report, and I also believe the earnings report was pretty much in line with the expectations. So no major surprises here. Management team at Alimentation Couche-Tard will focus on returning value to shareholders via dividend and share buybacks. They announced another dividend increase of 14.3% and mentioned that they bought back 8.7 million shares in 2025 so far. They showed good growth numbers in their net earnings and EBITDA in the past couple of years, but usually a major part of this growth did not come from organic same-store sales. In the history of Alimentation Couche-Tard, the share price growth usually came from successful acquisitions and also aggressive share buybacks. They did many different acquisitions of fuel and grocery store chains in the past. They were able to successfully integrate these businesses into their network, optimize their processes, and increase the margins. But none of these deals were larger than what they are trying to do right now with 7 & I, the holding company of 7-Eleven Japan, which is worth almost $38 billion. I mentioned in other videos that I don't think Couche-Tard share price will move dramatically to the upside or downside here before we can see the fate of this huge deal. I think the share price will hover between $65 and 75 Canadian dollar until we see an agreement with 7 & I. I'm happy with my position size in Couche-Tard and will hold my shares for now. But if the share price goes under $65, I will actually buy more shares of Couche-Tard. Okay, let's move on to the next position. Next, I have 330 shares of Brookfield Corporation. I'm up 62% on the position so far. The stock continues to do very well, and it is close to its all-time high share price. I think when big fund managers like Bill Ackman started to invest in the company, it also helped with the company name to be heard more and more in mainstream media and YouTube, and now there are a lot of people covering this stock. I believe even here, close to its all-time high, Brookfield Corporation is undervalued, and it is still a good place to invest money. I recently bought 50 more shares of Brookfield and averaged up on the stock, as I can see value in the business even here. Next, I have 235 shares of EQ Bank, which is up close to 62% now. I bought 35 more shares of EQ Bank during the recent downturn of the share price, and I'm totally happy with my weighting and position size in this great company. EQ Bank CEO Andrew Moore, which I covered a couple of his interviews on the channel before, unfortunately passed away suddenly last week. It is really sad to see him passing. He did a really great job at EQ Bank. From a small digital bank to now 7th largest Canadian bank, that was a major win for a CEO of any public company. It is certainly counterintuitive for a stock price to rise after the unexpected passing of a long-serving and respected CEO like Andrew Moore. So, in traditional market reaction, the sudden loss of a key leader like Andrew Moore often should lead to uncertainty and stock decline. So now you may ask why the stock is up significantly after CEO passing away. Well, EQ Bank had been working on a CEO succession plan for the past 2 years in anticipation of Andrew Moore's planned retirement. So it was not a surprise for the company nor the shareholders in terms of finding a new CEO. The company quickly named Marlene Lenarduzzi, their chief risk officer, as interim CEO. The strategic direction, digital infrastructure, overall business model are, I think, robust enough to continue its growth even without Andrew Moore. Even when some investors were really bearish on EQ Bank after the recent earnings report, I remain optimistic in the company. EQ Bank is much a smaller bank compared to Big Six Bank in Canada. Therefore, it is expected that they show more volatility in the quarterly earnings. What is important for me is to see their growth in the long term. I believe this company can still grow and outperform other major banks in Canada, take more market share from them in the coming years. My plan with EQ Bank inside my TFSA is to hold the stock and enjoy the growing dividend of the company. The last stock that I own here, which is a relatively new addition to the portfolio, is Intact Financial. I recently started to buy this stock, and I only have a starter position with only 5 shares now. I believe the stock here is fairly valued, and I am waiting for a dip in the share price to buy more shares and build my full position in the company. In the meantime, I will pick up a couple of shares here and there if the stock decides to just go up. There you are, guys. I hope you enjoyed the video, and if you enjoyed the video, consider subscribing to the channel to see similar videos. I will come back with a few stock analysis videos soon, but until that time, I see you guys in the next video. Farewell.